Well, I think the markets are down to today for three reasons, and that's worries over recession, valuation, and Q3 earnings. So, first of all, with the Fed tightening even more than expected, perhaps 100 basis points coming up, what does that mean for the future depth of a recession, which we do think will hit? The other issue is market valuations. Often, when you see the Fed tightening this much, you can see market returns being positive the next year, but valuations have, in those periods, have been much lower than they are today. So, market valuations are too high, and that leads us to Q3 earnings. We're already seeing estimates drop by about a little over 5%, but the question is that enough? It's being led by tech stocks taking estimate cuts, but earnings probably still need to be the next shoe to drop. Whether we see that in Q3 or later on is in question, but all of those are why the market is revaluing downwards today.
And I'm cautiously optimistic, but I think the velocity today, that's really bothersome. I don't see panic. Look at the VIX. The VIX isn't even above 26. But what's interesting, and I think Peter's right, it's a comprehensive lens that we need to look through. And that's exactly what the Federal Reserve is looking through. Today, we are bothered by the higher than expected CPI data. But let's just look back at mortgage applications. They're down 25% year over year. We're seeing housing cool. We are seeing used car prices. That was the biggest input, if you remember, Ty, during the pandemic. Everyone was going out buying used cars. That number is abating. It was down 4% in the month of August. So I think there's other ways to look at inflation potentially abating, but the Federal Reserve is not going to do 100 basis points. Yes, I said it. They are not going to do 100 basis points. They have been articulating in the defense of Fed Chairman Powell. He has been articulating they have the ability to be nimble, but they do have a problem. The problem was a year ago, they were still buying assets. They were just buying assets up until February of 2022. So they need to get the September meeting at 75 basis points in the rearview mirror.
I think it's more than that, because I think the Fed is trying to tell you that even if we get some good data, they're not going to declare victory early. They're very concerned about getting it down and keeping it down, and they're very nervous that this is something that could infect the anchoring of long-run inflation expectations. And I think the market's getting too excited too early. That's been a theme for us. The upsides are very limited. The downsides are risky, but I'm still not in the kind of cataclysmic downside camp, because I just think nominal GDP growth is gonna keep stocks from really taking a big swing lower. But we're gonna get these violent upswings and downswings as people shift their sentiment too quickly for a Fed that's not really shifting anytime soon.
The simple thing to think about is until the Fed is done raising rates, until we are inside a honest to God recession where you've got unemployment spiking, all you're trying to do is catch bear market rallies, and then you're going to lose even more money on your way down.